Hey traders, Bishu here at Long to Bear Trading Institute, here for your market wrap week ending 1st of February. Just going to quickly go through what we had last week. Then we're going to look at some opportunities for the coming week. Title of this video is the S&P ready to fall? And I'll get into that later on. I believe that we are very close to a pullback, and we probably have an opportunity to jump on board. So let's look at what the macro themes were last week. Well, it's earnings season, so mostly the focus goes on earnings. We saw Apple, Amazon, Facebook, Microsoft all give their earnings last week. It was semi-positive. If not, it's probably more of a slowdown than last year. Q1 would be the biggest factor to see if the effects of Q4 was just a one-off or is a actual slowdown in all these companies, these mega cap companies. The Fed meeting last week, again, Powell just doing his 180, going from hawkish to dovish. So we'll talk about that and show you a few charts that was on social media, so you can have a look at that. So last week we seen Caterpillar. They missed on earnings, and they are guiding more below for 2019. Vale are one of their largest consumers, and with the Brazil dam disaster, Vale are quite linked to that. We're going to see a lot of stress on Caterpillar's stock price going forward. So it'll be a stock to definitely have a look at. Check out the fundamentals of that, and maybe put some bets on the downside. So let's talk about Apple. Well, Apple on January 4th came out saying that they are guiding lower for their earnings. The earnings was released and it was better than they feared. So the stock reacted obviously positively. Traders took to that as it wasn't a big deal. And we've seen a rally in Apple this week. Now, if you see the underneath that, Apple actually did have a worse quarter than they did last year, because their earnings in China was significantly lower than last year. So you can see here 17.95 billion was their revenue last year, compared to this year at 13.17 billion. So you're looking around nearly 5 billion there revenue loss. Nvidia also missed guidance as well. So all these big companies have been missing guidance this past earnings, and it'll be quite interesting to see what their comments will be. They may have had good reactions on the stock price, but I think this is maybe the start of something, a theme going into 2019, 2020. So let's talk about Europe. Well, Italy is putting themselves at recession risk. Their data has been so abysmal lately, and it's showing signs of recessionary risks. That's just not the same for Italy. Germany's on there, France is on there. Europe as a whole is slowing, and this is not just a Europe thing. This is actually global. We see in China, Europe, and America will be next, maybe, but for now we're seeing China and Europe starting to contract. So once we see global growth begin to slow, then it should trickle down to US. If it doesn't and US remains resilient, which it has, then US would be the equity market that you want to pile your money in, because it's outperforming all the other indexes across the world. So US PMI grew to 56.6 from 54.3, sorry. However, if you look into the ISM comments, the managers sees a slowdown across the businesses coming into their next quarter. Let's talk about Amazon, giant as well. Their Q4 revenue and operating income was a positive. It was a beat. However, due to regulatory headwinds in India, what they're doing is India are not allowing Amazon to sell their own products in India. They'll only allow other vendors to sell their stuff on Amazon. So restriction on Amazon sort of took the stock negative over the week. So even on Friday, it closed nearly 5% down. Case-Shiller index, so that again disappointed. I don't think this is over. I think we're going to see more headwinds coming into this year. This is also just another evidence of a slowdown going on globally. And the Case-Shiller index, if you don't know, is the housing index in America. It tracks the housing prices. So have a look at that, and it's starting to roll over. So let's talk about Jay Powell. Jay Powell basically did a full 180, going from hawkish to dovish. In November last year, he was very hawkish, looking at doing more rate hikes, reduction of the balance sheet. That didn't go down well with Donald Trump. Donald Trump absolutely bashed him on Twitter. Didn't like any rhetoric that was coming out from the Fed, and was reacting like a baby, throwing his toys out the pram. And since then, you've seen the S&P react quite badly in the last quarter, and it was down nearly 20%. So we're just going to see now if Jay Powell remains calm, or if he just succumbs to Donald Trump and basically just does what Donald Trump says, and remains to pump the market to new highs. So let's look around what the markets did over the week. So global indices, we've got the American indices, the S&P, Dow, Nasdaq, the Russell, all up the whole week. So if you were long all those indices last week, you couldn't have lost money. You would have gained money. So it was good equity market to be in. FTSE had a very good week, strong week at 3.1%. DAX with slowdown on their data had a negative week at 0.5, but the rest of the indices across the world had a positive week. So it was good to be long equity indices. So got currency markets. So currency markets now, we've seen Euro have a very good week. It was an outperformer of the other, out of the dollar and the other major currencies. So if you were long Euro this whole last week, then you couldn't have been wrong really. You would have made some money. Pound didn't have a good week at all last week. Obviously headwinds on Brexit is still the forefront of the sterling. So let's see what happens next week, going into the final weeks of our Brexit. Let's see what the decision is. At the moment, it's a shambles. So this is a chart or a picture that was posted by Jesse Felder. Just have a look at it. I mean, it just sees where the market has gone since the 180 U-turn from Powell. And every time Powell has given a dovish comments, we've seen more of the S&P going up and up and up. So I mean, obviously we're in that environment now. Bad news becomes good news, and good news is obviously good news. So at the moment, we're not seeing any pullback in the equity markets, and we're just going to see what the Fed does in the coming months. Again, this was via Twitter as well. You can see at every other comment that Powell has done, how the reactions of the S&P was. So we're just going to go into some charts. Let me just see what opportunities there are next week, and let me just do that right now. So this is the S&P 500 weekly chart. As you can see, since 2016, we've been in a massive uptrend. We broke that trend line October last year, and we had a decline all the way down to the 2350 level. We started to see a rapid increase, around about 15-16% rally since then. The reason why I think the S&P is ready to fall is because I'm basically looking for a pullback, really. Maybe to the lows or maybe lower. But for the moment, I'm just going to play it level to level. I've got a green line, red line here. These are basically my bull market and bear market levels. You can see how I calculated it here. I just put it up for you there. That's basically how I've calculated it. And if you can see, basically, from the top, I mean, we literally went to a low of 23.46. Bear market level is 23.52. We broke that. Then technically, we would go much lower, in my opinion. We saved that, and we have begun to rally since that. Anything above 28.22 would be a trigger for me, maybe to go long, cautiously, but go long, and possibly to new highs. So let's have a look. Let's dig in. So is the S&P ready to fall? Let's have a look. Well, one thing I like to do is just go straight into the Fibonacci's. Where have we come from? Well, the high here, we've come from 29.40 down to the 23.50 level, roundabout. Okay, do that again. 23.50 level, and you can see basically we're at the 62% retracement level. We've got confluence as well around that area where the 250-day moving average is there above. So we could see some overhead resistance around the 27.15, 27.30 area. We might see a reaction. That's where we can possibly go lower. What I'm seeing for now on the daily, how I would play this is if the market decides to give us a pullback, well, I'm not looking to play this downside here because we don't know if the market's going to come here or not. But one thing's for sure is with any pullbacks, it actually respects the Fibonacci ratios. So I'm looking, if the market was to give us a short selling opportunity, it's just to play it down to the 50% to the 61% level, and that'll be a good risk reward ratio. If you short it at the open at 27.05, stop at 27.16, 17, down to the 62 level or the 50% level, it's a great trade. So that's what I'll be looking for going into next week and the coming weeks. What gives my confirmation again is I'm seeing some divergences on the charts now. So this is the daily. Let's go down to the 2 hours chart, and you can see clearly here we've got some divergences going on in the S&P 500. It doesn't mean that the price can't still go up. It definitely can, but it's definitely weakening. The rally that we're seeing in the past few days, it's going out of steam. So this is why I'm more prepared to go on the short side than I am on the long side. Even if you go on the 15-minute chart, let's get rid of that. 15-minute is very weak. From the top of the RSI here, 87, which is around the 26.91 level, we've got some divergences happening. So how would I play this? Well, I'm actually currently short at 27.05. I believe that we are ready to roll over and possibly fill this gap here. And we've got another gap at the 24.70-80 level. One thing that's going to be resistance will be here. This was the breakout level. You can see we broke out, we retested it, and we've rallied since then. So if we break the 26.95, 26.93 level, and we get a retest of that line, I'll suggest that we would initiate a short position, stop at 27.20 and look for targets. First target at 26.40, get that gap, and then down to 2600 and then 25.50 and so on. Just keep on trailing your stops. If, however, we fail at resistance at the 27.75 level, you could always adjust your approach. I always look at adjusting my approach. Don't get married to a bias. It will always rip you apart. So if we come to the 26.75 level and we get a reaction, strong reaction, then simply go long. And I would look at least first target to take out this high at 27.17, and then possibly go to 2800 level, or the top of this wedge here. Okay, I'll show you another chart. It's the VIX. So let me just go on to that now, and that's just probably adding a bit more confirmation to my bias, why I think that we could be looking more upside in the VIX and more downside in the S&P 500. This pink box here is a range of resistance, and it spans back all the way from last year, and we're hitting it now. And either we go below it and we close, and we meander all the way down to the low teens of volatility. But since October, we have kept it as resistance all the time, and we're now forming a bullish wedge, really. And we break out of this, I think we could easily test the top at 36, or even maybe do a 50% pullback down to the 26-27 area of the VIX. So one way to play this as well is go long VIX and short the S&P 500. That would be a very good risk reward trade that you could do. And also, what we see here is I see some positive divergences here. So just show you, I see some positive divergence going on here, and that's probably adding a bit more conviction to my thesis that I think the S&P is ready to fall. So I don't want you guys to risk too much. Trade your plan, and or make sure that if your plan's not going to work, readjust, and either come out the trade completely, or readjust and look for other ideas. There's so many markets out there, but that's what I think about the S&P for now, and I'll catch you next week.